Welcome to The Explainer. Look, if you're a financial executive trying to navigate the absolute whiplash in global markets right now, you are in the right place. We've got a seriously fascinating dataset to unpack together today. We're looking at the macro data for the week of May 25th to May 29th, 2026, and honestly, one core theme is just jumping right off the page: global central bank divergence. The old unified monetary policy playbook? Yeah, it's fracturing right before our eyes. And figuring out how to position your portfolio around these massive structural shifts is absolutely going to define your quarter.
Okay, let's dive into this with a quote straight from the recent Federal Reserve Minutes that really caught my eye. They cite deep concern over out-of-control inflation, with several FOMC members increasingly open to actual rate hikes. Now actually, scratch that. This isn't just bureaucratic posturing. This is the literal reality we are waking up to. The Fed's renewed inflation fears are completely dictating the global pulse right now, and practically every other central bank is being forced to react to the ripple effects of this aggressive U.S. posture.
So here is our roadmap to make sense of this divergence today. First, we're going to set our global macro baseline. Second, we'll look at the aggressive inflation hawks. Third, we'll pivot to the central bank dilemmas. And finally, we'll wrap things up with the resilient commodity play. Grouping these thematically is going to make the comparative reality of global markets crystal clear.
Let's move right into Section 1, our global macro baseline. Because before we can even talk about individual currencies, we really need to understand the geopolitical forces pushing and pulling the US dollar.
So, the US dollar index, the DXY, has been consolidating in this incredibly tight range lately, right between 98.80 and 99.40. Why? Because it is getting whipsawed by headlines. Early in the week, we saw hostile drone attacks give the Greenback a super strong safe haven footing. But, in typical market fashion, that didn't last. By midweek, top-tier headlines broke about a new Iranian peace proposal. Then, late in the week, President Trump remarks that negotiations are in their final stages, which successfully pulls crude prices back down. This whole sequence of events effectively capped the dollar's immediate advance, locking it right into that tight channel.
But here's the thing, if you look closely at the data, a capped rally definitely doesn't mean a weak dollar. Markets are currently pricing in a massive 70% chance of a 25 basis point Fed rate hike before year-end. So despite all that geopolitical noise cooling things down, the dollar remains heavily supported because the market is absolutely convinced the Fed is not done fighting inflation.
And that brings us to Thursday. These critical U.S. data drops are going to be the ultimate stress test for that 70% probability. We're watching the April Core PCE Index, which, as you know, is the Fed's preferred inflation gauge, along with personal income and spending, and the second estimate for Q1 GDP. Following those recent, hotter-than-expected CPI and PPI prints, the risks here are tilted heavily to the upside. If inflation runs hot again, and we see resilient growth in that GDP print, it's going to firmly cement the case for an impending rate hike. That combo would be pure rocket fuel for a fresh leg up for the USD.
All right, Section 2, the aggressive inflation hawks. Let's look at the nations that are fiercely fighting this inflation wave right alongside the U.S.
And this brilliantly illustrates exactly what we're talking about. Look at this alignment across the Pacific. The U.S. is staring down upside inflation risks with that 70% hike probability. Meanwhile, New Zealand is dealing with a sharp acceleration in inflation, and markets are pricing in roughly 3/4-point hikes by the end of 2026. And Australia? Their inflation is literally skyrocketing, which implies another 70 basis points of tightening by the end of 26. These three economies are totally bound together by steepening tightening paths.
Let's zoom in on New Zealand for a second. Wednesday brings the Reserve Bank of New Zealand policy decision. An actual hike this Wednesday is a low probability, only about 25%. They're widely expected to hold the official cash rate at 2.25%. But make no mistake, a hold does not mean dovish. The RBNZ has been incredibly hawkish in their rhetoric, explicitly warning about how Middle East energy strains are hitting growth and price stability. A hawkish hold on Wednesday virtually locks in an 80% probability for a July rate hike, and that dynamic is actively driving the Kiwi higher. Now, what's really interesting about this slide is the situation unfolding in Australia. Their April CPI report hits just 30 minutes before the RBNZ decision. Just look at this trajectory. The Reserve Bank of Australia has a target maximum of 3.0%. The previous CPI was already running hot at 3.7%, but the current CPI, it has surged to 4.6%. Even if the RBA wants to pause and wait for more data, an acceleration like this totally forces their hand. Traders have no choice but to price in a much steeper hiking trajectory, giving the Aussie dollar a ton of upward fuel.
But while the hawks are charging forward, other regions are facing a much more brutal reality.
Let's move to Section 3, the central bank dilemmas, specifically focusing on Japan and the Eurozone.
We have to start with Japan's immediate vulnerability. The USD/JPY pair has drifted right back into the highly volatile 158 to 160 zone. And guys, this isn't just a technical level on a chart. This is the exact threshold that triggers heavy, explicit warnings of physical market interventions from Finance Minister Satsuki Katayama. Japan is fighting an all-out defensive war to protect its currency. But the Bank of Japan has a massive monetary policy dilemma of its own right now, especially ahead of some crucial Friday data. Right now, the OIS market is pricing a 75% chance of a BOJ rate hike on June 16th, with a second hike already fully factored in by year-end. Friday brings May's Tokyo CPI and April's industrial production numbers. If those Tokyo numbers print hotter than expected, it solidifies that 75% probability. And honestly, that's the ideal scenario for the BOJ right now. Higher domestic rates give the yen independent fundamental strength, which naturally saves them from having to execute those messy, direct market interventions.
Over in Europe, though, the dilemma is structurally worse. It is essentially a central banker's worst nightmare. So the crucial point is this contrast. On one hand, accelerating inflation is forcing the ECB into an aggressive hiking cycle. On the other hand, the underlying economy is actively shrinking. The Eurozone is bearing the absolute brunt of the Middle East energy crisis, and you can see it clear as day with the flash composite PMI sliding deeper into contraction territory at an ugly 47.5. You simply cannot hike your way out of a contracting economy without causing massive pain. This is why the euro remains so fundamentally vulnerable.
To gauge exactly how much pressure the ECB is actually under, all eyes are on Friday's key Eurozone leading indicators. We're getting preliminary May CPI data from the three heavyweights, Germany, France, and Italy. How these specific prints land will act as vital leading indicators for the aggregate Eurozone CPI release on June 2nd. If these numbers run hot while the PMI stays stuck in contraction, wow, that stagflation nightmare becomes incredibly real for European markets.
Finally, let's look at a region playing an entirely different game. Section 4, the resilient commodity play. Let's talk about Canada.
Canada is really standing out right now as a unique, insulated outlier amid all this global turbulence. As the world's fourth largest oil exporter, the Canadian dollar is putting up a remarkably resilient performance, backed consistently by those elevated crude oil prices. We're keeping a close eye on Friday's release of Q1 and March GDP data. If that data shows solid evidence of economic resilience, it is going to give the loonie exactly what it needs to secure further gains against its major peers. It's a pure commodity-backed macro play. And right now, it's a rare safe harbor in a world full of inflation uncertainty.
Well, we've covered a massive amount of macro ground today. From the aggressive hikes over in the Pacific to very real stagflation fears in Europe, all of it anchored by a stubbornly strong US dollar. So I want to leave you with this question as you look at your own risk exposure. How is your portfolio positioned for this central bank divergence, particularly if Eurozone stagflation collides head-on with a structurally stronger US dollar? Because make no mistake, this is the defining financial current of the moment. Take a hard look at these insights, evaluate your allocations, and let's see how the market prices this all in. I'll see you in the next explainer.